Fuel prices have already moved higher across the United States, and for many households the change has not been temporary. The cost of fuel rose within a short period of time, but it has not returned to earlier levels with the same speed. That difference shapes how expenses are experienced at home. Costs increase quickly, and then remain elevated even after the initial disruption is no longer visible. By late April 2026, the national average price of gasoline had reached roughly $4.18 to $4.23 per gallon, with higher levels in some regions. That increase followed a reduction in refining capacity of approximately 800,000 barrels per day. When that capacity was taken offline, the amount of fuel entering the system declined. Demand did not fall in response. The system adjusted through price. This is how the first phase occurs. When supply is reduced quickly and demand remains stable, prices move upward without delay. The system reflects the imbalance directly because there is less fuel available to meet ongoing consumption. The adjustment is immediate. The second phase depends on whether the system can restore balance. For prices to decline in a sustained way, supply must recover, and inventories must rebuild. The system requires both. Supply provides new fuel entering the market, and inventories provide the buffer that allows the system to adjust gradually. Without that buffer, the system becomes more sensitive to change. By the time prices had moved above $4 per gallon, the conditions required for recovery were not in place. Inventories had already begun to decline across multiple categories. Gasoline inventories fell by approximately 6.1 million barrels. Crude inventories declined by about 6.2 million barrels. Diesel supplies dropped by roughly 4.5 million barrels. These changes indicate that the system was using stored fuel to compensate for reduced production. Inventories serve a structural role. They absorb the difference between supply and demand. When production falls short, inventories fill the gap. When production exceeds demand, inventories are rebuilt. This mechanism allows the system to operate without sharp or immediate reversals in price. The effectiveness of this mechanism depends on the level of inventories available. When inventories are sufficient, the system can absorb disruptions and gradually return to balance. When inventories are reduced, that capacity is limited. The system becomes more reactive, and price adjustments are more difficult to reverse. By late April, inventories were not only lower, but still being drawn down. This indicates that the system had not reached a point where it could begin rebuilding its reserves. Instead, it continued to rely on them to maintain supply. At the same time, refining capacity remained constrained. The earlier reduction of approximately 800,000 barrels per day had not been fully restored. Refinery utilization was reported at around 89.6%, indicating that available facilities were operating at a relatively high level. However, utilization reflects only the capacity that is active. It does not account for the capacity that remains offline. As a result, total output remained below what would be expected under full operating conditions. This creates a limitation on recovery. Even if demand remains stable, the system cannot increase supply quickly enough to rebuild inventories while also meeting consumption. The process of restoring balance is delayed. Another factor affecting this process is the level of exports. Crude oil exports were measured at approximately 6.44 million barrels per day, and total fuel exports reached around 14.18 million barrels per day. These flows represent fuel leaving the domestic system while inventories are already being drawn down. Exports are part of normal market operations, but their effect depends on the condition of the system. When supply is sufficient and inventories are stable, exports do not create significant pressure. The system has enough capacity to meet both domestic and external demand. When supply is constrained and inventories are declining, exports reduce the amount of fuel available for domestic use. This contributes to the overall tightening of supply. Fuel enters the system at a reduced rate due to constrained refining capacity. Fuel leaves the system through consumption and exports. The difference is absorbed by inventories. As inventories decline, the system loses its ability to compensate for that imbalance. This is where the pattern becomes clear. Prices increase quickly when supply is disrupted because the system must respond immediately to the imbalance. Prices do not decline at the same speed because the system requires time and capacity to rebuild supply and restore inventories, and those conditions are not present. For households, the result is a period in which costs remain elevated. Fuel expenses increase and persist over time. The expectation that prices will return to earlier levels is delayed because the underlying conditions that would allow for that adjustment have not been restored. This effect extends beyond fuel purchases. Transportation costs are tied directly to fuel. As fuel prices remain elevated, the cost of moving goods increases. Over time, those costs are reflected in the pricing of goods and services. The process is gradual, but it is consistent. Fuel cost increases lead to higher transportation costs, which lead to higher distribution costs, which affect the price of goods. This sequence reflects how the system transmits cost. At the same time, the reduced level of inventories increases the system's sensitivity to change. When inventories are high, the system can absorb fluctuations in supply without immediate impact. When inventories are low, even small changes in supply can affect price more directly. The system becomes less stable. This instability affects how prices behave. Prices remain elevated because the system cannot easily rebuild supply. They also become less predictable because the margin for adjustment has been reduced. For households, this creates uncertainty in addition to higher costs. Expenses that were previously stable become more variable. Budgeting becomes more difficult when costs do not follow a consistent pattern. The effect is not limited to fuel. It appears in the pricing of goods that depend on transportation and distribution. The current condition of the system explains this behavior. Refining capacity remains below its previous level. Inventories have declined across gasoline, crude, and diesel. Exports continue at elevated rates. Each of these factors contributes to the same outcome. The system operates with less buffer and less flexibility. This is why prices rise quickly and do not return at the same speed. The difference is not temporary. It reflects how the system responds to disruption and how long it takes to restore balance once that disruption has occurred. By early May, the system had not yet completed that process. Supply had not fully recovered. Inventories had not begun to rebuild. The flow of fuel remained constrained. These conditions define the current state of the market. For households, the effect is already present in the persistence of higher costs. The system continues to function, but it does so under constraint, and that constraint determines how prices behave and how those prices are experienced in everyday life. The initial increase in fuel prices can be traced directly to a disruption in supply, but the persistence of those prices reflects a different phase of the system. Once the immediate imbalance has been priced in, the system does not automatically return to its previous state. It must rebuild the conditions that supported lower prices, and by late April and early May, those conditions were not in place. The most important of those conditions is inventory. Inventories function as the system's buffer. They allow supply and demand to remain balanced even when production changes. When production falls short, inventories are used to maintain continuity. When production recovers, inventories are rebuilt. This process determines whether prices stabilize or remain elevated. By late April, inventories had declined across all major categories. Gasoline inventories were down by approximately 6.1 million barrels. Crude inventories had fallen by about 6.2 million barrels. Diesel supplies declined by roughly 4.5 million barrels. These figures indicate that the system had been drawing from its reserves to compensate for reduced refining output. This is the point at which the second phase becomes clear. Prices do not fall quickly because the system no longer has the buffer required to absorb change. Instead of stabilizing, the system continues to operate with reduced reserves. Each unit of fuel consumed is replaced more slowly, and the overall level of available supply remains tight. At the same time, the constraint that caused the initial price increase had not fully reversed. Refining capacity remained reduced by approximately 800,000 barrels per day. Even with utilization levels around 89.6%, the system was operating below its full potential. The available facilities were active, but total capacity had not returned to previous levels. This meant that the system could not increase output quickly enough to rebuild inventories while also meeting ongoing demand. The result is a delay in recovery. For prices to decline, supply must exceed demand for a sustained period. That excess supply is what rebuilds inventories and restores the system's buffer. Without that surplus, inventories cannot recover, and prices remain supported at higher levels. Another factor reinforcing this condition is the continued level of exports. Crude oil exports were measured at approximately 6.44 million barrels per day, while total fuel exports reached around 14.18 million barrels per day. These flows represent fuel leaving the domestic system during a period when inventories were already declining. Exports do not necessarily create imbalance on their own. However, in a system that is already under pressure, they reduce the amount of fuel available to restore balance. Fuel that could contribute to rebuilding inventories instead moves out of the system. This creates a persistent gap. Fuel enters the system at a reduced rate due to constrained refining capacity. Fuel leaves the system through consumption and exports. The difference is absorbed by inventories. As inventories decline, the system loses its ability to offset that gap. This interaction explains why prices remain elevated even after the initial disruption. The system has not yet reached a point where it can generate surplus supply. Instead, it continues to operate at a level where supply is only meeting or slightly below demand. Without surplus, there is no mechanism to bring prices down in a sustained way. At this stage, the behavior of the system changes. In the first phase, prices respond quickly to a reduction in supply. In the second phase, prices remain elevated because the system lacks the capacity to reverse that imbalance. The speed of the initial increase is not matched by the speed of the decline because the conditions required for decline take longer to establish. For households, this distinction is reflected in how costs are experienced over time. The initial increase appears as a rapid change in fuel prices. The second phase appears as persistence. Costs remain high across multiple weeks or months, even as the immediate cause of the increase becomes less visible. This persistence is not limited to fuel purchases. As fuel costs remain elevated, transportation costs remain elevated as well. Goods continue to move through the system, but the cost of that movement reflects the higher price of fuel. Over time, this cost is incorporated into the pricing of goods. This is how the effect spreads. Fuel cost increases lead to higher transportation costs, which lead to higher distribution costs, which are reflected in retail prices. The system transmits costs gradually, but it does so consistently. At the same time, the reduced level of inventories increases the system's sensitivity to change. When inventories are high, the system can absorb fluctuations without significant impact on price. When inventories are low, even small changes in supply can affect pricing more directly. The system becomes less stable, and price movements become less predictable. This variability is another characteristic of the second phase. Prices do not simply remain high, they also become more sensitive to new information. A small disruption can have a larger effect because there is less buffer to absorb it. This creates a condition where prices remain elevated and respond more quickly to additional pressure. For households, this introduces uncertainty. Costs are not only higher, but less predictable. Budgeting becomes more difficult when expenses do not follow a consistent pattern. The effect extends beyond fuel into other categories of spending that depend on transportation and distribution. The current structure of the system explains both the level and the behavior of prices. Refining capacity remains constrained, limiting supply. Inventories remain reduced, limiting the system's buffer. Exports remain elevated, reducing available supply for domestic use. These factors combine to prevent the system from rebuilding balance. Without balance, prices do not decline in a sustained way. This does not require speculation about future conditions. It reflects the current state of the system. The elements that would allow prices to fall: higher production, rebuilding inventories, and reduced outward flow, are not yet present at the scale required to change the trend. As a result, the system continues to operate under pressure. The initial price increase has already occurred. The second phase is defined by the absence of recovery. For households, this means that the higher cost environment persists. Fuel prices remain above previous levels, and the broader cost of living continues to reflect those conditions. This phase does not produce the same visibility as the initial increase, but it has a longer duration. It is the difference between a rapid change and a sustained condition. The system has adjusted to the disruption, but it has not yet recovered from it. And until that recovery takes place, the pattern remains in place. Prices rise quickly when supply is disrupted, and they do not return at the same speed because the system requires time and capacity to rebuild its balance. The system does not return to balance at the same speed that it moves away from it. By early May 2026, the conditions that drove the initial increase in fuel prices had not been fully reversed, and the mechanisms required for prices to decline in a sustained way were still limited. The result is not a continuation of the initial spike, but a different phase in which prices remain elevated because the system has not rebuilt the capacity to stabilize itself. The structure of this phase is defined by three elements that continue to operate together. Refining capacity remains below its previous level following the earlier loss of approximately 800,000 barrels per day. Inventories across gasoline, crude, and diesel have declined, reducing the system's buffer. Exports continue at elevated levels, with crude at approximately 6.44 million barrels per day and total fuel at around 14.18 million barrels per day. Each of these factors contributes to the same condition. Supply is constrained. Reserves are reduced. Available fuel continues to leave the system. This combination prevents the system from generating the surplus required to restore balance. For prices to decline in a sustained way, supply must exceed demand for a period of time. That excess supply allows inventories to rebuild, which restores the system's ability to absorb fluctuations and stabilize pricing. Without that surplus, inventories cannot recover, and the system continues to operate with reduced flexibility. By early May, the data indicates that the system had not reached that stage. Inventories were not being rebuilt. They had already declined by approximately 6.1 million barrels for gasoline, 6.2 million barrels for crude, and 4.5 million barrels for diesel. These reductions reflect ongoing reliance on stored fuel to maintain supply. At the same time, refining capacity had not fully returned, limiting the rate at which new fuel could enter the system. This creates a condition where supply is not only constrained, but also unable to expand quickly. Crude production remains stable at approximately 13.6 million barrels per day, indicating that the availability of raw material was not the limiting factor. The constraint existed at the refining stage, where crude is converted into usable fuel. As long as that constraint remains, increases in crude supply do not translate directly into increased availability of gasoline or diesel. This distinction explains why the system does not recover quickly. The presence of crude does not resolve the limitation on refined fuel. Without sufficient refining capacity, the system cannot increase the output of the fuels that are directly consumed. This delays the process of rebuilding inventories and restoring balance. At the same time, exports continue to draw from the available supply. Fuel that leaves the system cannot be used to rebuild domestic inventories. When exports remain elevated during a period of constrained supply, they reduce the volume of fuel available for recovery. The system must meet domestic demand with a smaller effective supply, which limits the possibility of generating surplus. This interaction between constrained production, reduced inventories, and sustained exports creates a stable condition of pressure. It is not a temporary imbalance that resolves quickly. It is a structural condition in which the system operates with less capacity to adjust. For households, this condition is experienced as persistence. Fuel prices remain above previous levels for an extended period. The expectation that prices will return to earlier levels is delayed because the system has not restored the factors that supported those levels. The difference between the speed of increase and the speed of decline becomes more apparent over time. This persistence also affects how costs move through the broader economy. Fuel is a foundational input in transportation. As long as fuel prices remain elevated, the cost of moving goods remains elevated. Transportation systems continue to operate, but the cost of that operation reflects the higher price of fuel. Over time, these costs are incorporated into the pricing of goods and services. This process is gradual. It does not appear as a single adjustment, but as a series of incremental changes that affect different sectors at different times. Goods that rely heavily on transportation may reflect these changes sooner. Other goods may adjust more slowly. The overall effect is a broader increase in the cost of living. The transmission of cost follows a consistent pattern. Fuel prices remain elevated. Transportation costs remain elevated. Distribution costs adjust accordingly. Retail prices reflect those adjustments. This sequence connects the condition of the fuel system to everyday expenses. At the same time, the reduced level of inventories increases the system's sensitivity to additional disruptions. When inventories are high, the system can absorb unexpected changes in supply without significant impact on price. When inventories are low, that capacity is reduced. Even minor disruptions can produce noticeable effects because there is less buffer available to offset them. This increases variability. Prices do not only remain high, they also become more responsive to changes in supply. This responsiveness introduces uncertainty into the system, affecting both businesses and households. For businesses, variability in fuel cost affects planning and pricing decisions. For households, it affects budgeting and expectations for future expenses. The system continues to function, but it does so under conditions that are less stable than before. This instability is not the result of a single event. It reflects the interaction of multiple factors that remain unresolved. Refining capacity has not fully recovered from earlier disruptions. Inventories have not been rebuilt to previous levels. Exports continue to reduce the volume of fuel available domestically. Each of these elements contributes to a system that cannot easily return to its previous state. The absence of recovery is the defining feature of this phase. The initial increase in price was driven by a rapid reduction in supply. The persistence of that price is driven by the system's inability to restore balance. For households, the difference between these two phases is significant. The first phase is visible and immediate. Prices rise quickly and attract attention. The second phase is less visible, but more sustained. Prices remain elevated over time, affecting a wider range of expenses. This sustained effect shapes how costs are experienced in daily life. Fuel expenses remain higher than expected. Goods that depend on transportation reflect higher costs. Budgeting becomes more difficult as variability increases. These outcomes are not temporary adjustments. They are the result of a system operating under constraint. By early May, the data does not indicate that these constraints have been resolved. Refining capacity remains below full levels. Inventories remain reduced. Exports remain elevated. These conditions define the current reality of the system. There is no indication, within the available data, that the system has begun to rebuild the buffer required for prices to decline in a sustained way. The factors that would support that process are not yet present at the necessary scale. As a result, the pattern remains consistent. Prices increase quickly when supply is disrupted because the system must respond immediately. Prices do not decline at the same speed because restoring balance requires time, capacity, and surplus supply that are not yet available. This difference is structural. It reflects how the system responds to disruption and how long it takes to recover from it. For households, the effect is already in place. Costs remain elevated, and the broader cost of living continues to reflect the condition of the fuel system. The system continues to operate, but it does so with reduced flexibility and increased sensitivity to change. That condition defines the current state of the market. And until the system rebuilds its capacity and restores its buffer, the pattern remains unchanged.